One of Trump's campaign promises was to make Social Security income tax-free. Well, there are now several bills in the House that address this very issue. And yes, the president likes to move quickly, but there's no guarantee if and when one of these bills becomes law. In today's video, we're going to talk about how taxes on Social Security income works. We're also going to talk about the impact of these proposed changes on your retirement plan. And then finally, we're going to talk about some planning strategies for you to implement to help reduce the tax impact of Social Security income. But first, if you're new, my name is Kevin Lau. I'm the host of the Planning for Retirement podcast, and I'm also the owner of Imagine Financial Security. We help individuals over 50 with at least $1 million invested for retirement maximize their retirement spending, minimize their lifetime tax bill, and worry less about the financial markets. If you're interested in working with me one-on-one, you can visit our website at www.imaginefinancialsecurity.com, or you can start with the Retirement Readiness Questionnaire linked in the notes below. So before we talk about how Social Security income taxes work, let's do a little history lesson here. Why don't we rewind the tape all the way back to 1935 when Social Security was put into play. It was really designed to be a safety net, okay? It was not designed to be the primary income source for retirees. But at this juncture, at this point in time, 40% of retirees rely on Social Security for more than 50% of their income. Okay, so if Social Security wasn't around, most people couldn't even be retired. They would still be working, or they would be reducing their expenses dramatically, which I know most people don't want to do that in retirement. That's the whole point of retirement, is to sustain your lifestyle, sustain your standard of living after you quit your day job. Okay, so Social Security really has become a baseline of income for the majority of retirees today. The second thing is life expectancy. Okay, when Social Security was first put into place, age 65 was full retirement age, FRA. Well, guess what the life expectancy was at that point in time? 61 years old was the average life expectancy. All right, so basically it was set up for most people to never even receive the benefits. All right, now today, full retirement age, or the full retirement age for most individuals is now 67. So here, we've had Social Security for 90 years, and the full retirement age has gone up 2 years. When in life expectancy, I mean, most people that are 65 today are very likely to live well into their 80s, if not well into their 90s. Okay, so this is part of why Social Security is running into the problems that it is today. But ultimately, it was not designed to really pay out for most people. It was, again, really there to be that longevity insurance for folks that lived much longer than they anticipated, or that we anticipated for them to live. Okay. Now, the third thing to note is that it was not always taxable. Okay. In fact, before 1984, Social Security was completely tax-free. And then when that law came into place in 1984, then they established what's called the Social Security wage base, and they would tax the benefits up to that Social Security wage base. This year, for 2025, the max, or the Social Security wage base, is taxed up to $176,100. And the amount that is taxed is split between the employee and the employer. The employee pays 6.2%, and the employer pays 6.2%. So for a total of 12.4% of your income. So if you earn more than $176,100, it's still capped at $176,100. If you earn less than $176,100, then you still pay the 6.2%, but it would be on that wage base, whatever that might be. If you make $150,000 would be subject to these so-called payroll taxes. Now, the issue that I have, and many retirees have that are receiving benefits, is that essentially you're being taxed on the way in via these payroll taxes, and then your benefit is now taxable as ordinary income, or at least part of that benefit is taxed at ordinary income. So it's almost like, making a Roth account or an HSA account taxable to some degree. I know that's a little extreme, but ultimately, most of the benefits that are paid to retirees are funded from these payroll taxes. It's not like you're taking this 6.2% and the 6.2% that your employer provides, and you're putting that into a side fund, or the government's putting that into a side fund, and they're creating this benefit balance that you have access to at a later date. They're basically giving you an IOU and saying, this is what we think your benefit's going to be at your full retirement age or at 62 at your latest retirement age. Okay. I don't know about you, but I'd much rather take that money. I'd much rather take that 12.4% and put it into my own account. Because if I did that, let's say I was making at least $176,100. That means 6.2% plus 6.2%. That equates to a total of $21,836 that is being contributed to Social Security on my behalf via these payroll taxes. Imagine if you had 30 years of compounding interest at 7%, putting away $21,000, and let's say you adjust that for inflation every year, maybe it's 2%. Your balance at the end of 30 years is going to be $2.6 million plus. Okay, and that's if you earned a 7% annual compounded return. If you have a higher risk tolerance and you're more aggressive, you could expect maybe closer to 9 or 10% a year over the long term. And so would you rather have a $2.6 million plus account balance or a potential IOU from the government? I don't know about you, but I'd take the former. Okay, but that's not how Social Security works, so I digress. But it is important to note how these taxes work and how Social Security is funded, and sort of understanding that, most of the benefits, most of these Social Security benefits today are being funded by current payroll taxes. Okay, so there's not some sort of fund that is sort of building up that's paying out these benefits. It's essentially folks that are working are paying for the folks that are retired. Okay, that's just how the system works. It is a welfare system, Social Security. Okay, but how much is actually taxable? How does this actually work on the back end? So why don't we talk about this? All right. So here I have these income tiers, and what you'll see is once your benefit or once your income hits this first threshold, which is 25,000 for individuals and 32,000 for married filing jointly, up to 50% of your benefits could become taxable. Okay, included in your taxable income. That doesn't mean you pay a 50% tax rate. It just means up to 50% of that amount could be included in your taxable income. Once it goes above this first tier and hits this $34,000 for single and $44,000 for married filing jointly, then up to 85% of the benefit could be taxable. And that is the maximum amount of your benefit that could actually be included in your taxable income. Okay, so just for fun, if someone was making, let's say, $50,000 from Social Security, if you take 50,000 multiplied, and let's say they're married filing jointly, and you multiply that by 0.85, which is 85%, that comes out to $42,500. So this is the maximum amount that could be included as taxable income from those Social Security benefits. Okay, so just kind of understand how that works. But another thing that is key to this is, what is income? Like what are they even talking about here? Because the IRS, they like to throw out all these confusing terms for income: adjusted gross income, modified adjusted gross income. And there are a bunch of definitions for modified adjusted gross income. Then you have taxable income. Okay, well here, I'm going to have to throw another one at you. And this is what they like to call provisional income, also known as combined income. Okay, so that's what they're talking about when they're talking about income. Okay, is your provisional income or combined income. Now, really simply put, the way you calculate this is you essentially take your adjusted gross income, excluding Social Security. So let's say AGI excluding Social Security. You add back tax exempt interest, which is pretty common for modified adjusted gross income calculations for things like IRMA surcharges. They typically will add back tax exempt interest, which for the most part is municipal bond income. And then you'll add 1/2 of the Social Security benefit. That's your provisional income. Okay. And that is the income number that you are going to use to feed into these tiers to determine how much of your Social Security is going to be taxable. So why don't we actually run through an example here? Let's say we have a married filing joint couple and they have a Social Security benefit of $40,000. Let's say they're taking some distributions out of IRAs. Maybe it's required minimum distributions, or maybe it's just distributions. Maybe it's even Roth conversions. Who knows? But it's $20,000 is coming out of their IRA that's fully taxable. Then there's $15,000 in capital gains. Okay, so this could be distributions. It could also be sales from investments. Okay, this is very common for folks that are drawing money from their taxable brokerage account. They may have to sell investments, and some of those investments may have embedded capital gains in there that are now realized into either long or short-term capital gains, and that would be included as income for them. And then we have dividends and interest income. So how would we calculate provisional income in this case? Well, 100% of this is included, 100% of this is included, 100% of this is included, but over here, we've got 50%. Okay, so instead of $40,000, we have 20K is included in this provisional income calculation. So if we have $20,000 plus $20,000 here, plus $15,000 here, plus $5,000 here, that takes us to a grand total of $60,000 of provisional income. Okay, so this is the number that we want to focus on. Now they are married finally jointly, so let's feed it through the system here. So in the beginning, anywhere less than $32,000 of provisional income, $0 will be included in taxable income. Here, for anywhere from 32,000 to 44, which check, we've got more than 32 and we have more than 44. So we would include $12,000 in this tier. Up to 50% would be taxable. So just take 50% times this. That brings us to $6,000 is included in this tier in your taxable income. And then over here, over 44,000, which again, check. We have upwards of 60. So if you take 60 minus 44, we need to feed $16,000 through this tier. Multiply that by 85%. The math right here, that would be $13,600 would be in this tier. So if we take $0 plus 6,000 plus 13,600, we get a total a taxable Social Security amount of $19,600. That is the taxable Social Security amount. That is the number that you are going to include on your tax return. So on your tax return, on one side, you have total Social Security benefits, and then on the other side, you have taxable Social Security benefits. And that's the amount that's going to be fed through your tax return and going to be subject to income taxes. Okay. So 19,600, if you divide that by the $40,000 that we mentioned up here, that's just under 50%. So it's around, let's call it around, 49.5% is included in taxable income in this case. Okay. Now, what would the benefit or what would the impact be if these Social Security taxes were completely eliminated? So on the surface, the obvious one is number one here is that it's going to increase income for retirees. Duh. At the end of the day, if you're paying less money to Uncle Sam via taxes, you have more money in your pocket to spend on travel, to just pay for lifestyle, combat inflation, whatever that might be, gift to charity. Okay, so obviously on the surface, it's like, oh, this sounds great. Who wouldn't be in favor of this? Okay, but the downside is what is going to be the funding mechanism to pay for this less tax revenue that is going to the IRS? Now, at the end of the day, this is not a large percentage in terms of funding amount to pay these Social Security benefits. A very small percentage of these income taxes generated from retirees or other individuals that are collecting Social Security benefits are actually used to keep the system solvent. But it is something. So ultimately, if you get rid of that, the difference has to come from somewhere. And from my guess, there's a few different scenarios that could potentially happen. I think a very likely scenario is an increase in payroll taxes. Okay, so is it do they take the 6.2% and increase that? Do they increase the taxable wage base above that $176,600 or $176,100? Okay, so do they do something with that figure there? I think those are very, very likely. But in my opinion, I don't know if Trump is going to sign on for that. Do you think Trump is going to want to increase taxes for individuals, for the working class? I don't know. That's not really what he's about. Okay, So I think another scenario that's on the docket is essentially reduced Social Security benefits. All right. And so at the end of the day, right now, there's a Social Security trust fund. Okay. So the Social Security trust fund essentially is used to shore up the shortfall. There's been a shortfall in Social Security for several years now, meaning the amount that's collected from the government via the payroll taxes is not enough revenue to pay out all the Social Security benefits that are going on. And the reason is because 10,000 baby boomers retire every day. More and more people are on Social Security. They're living longer. So just, the projections in terms of how much benefit would need to be paid out, it was underestimated. So therefore, there's a trust fund that has been set aside to shore up the gap. Well, that trust fund is set to be completely gone by 2034. And if this goes into effect, if Social Security becomes tax-free, it's not a huge impact, but essentially is projected to essentially accelerate that depletion to 2033. So essentially by a little over a year. Okay. Now, this may not seem like a big deal, but again, if nothing happens, if they don't increase payroll taxes, if they don't increase the taxable wage based on Social Security, I think a very likely scenario is they're just going to have to reduce Social Security benefits. So instead of paying what their current estimates are, the estimations are going to be closer to maybe 80% or even downwards of 70% of your current estimated benefit. So from a planning perspective, I would really consider this one is to say, hey, you know what? I don't know if I'm going to get 100% of what my Social Security statement says. So instead of plugging this exact dollar amount into my financial planning calculations and my planning projections, maybe I assume 80% or maybe I assume 70% of this current Social Security benefit to be a little bit more conservative. And therefore, you need to rely a little bit more on your own assets, your own saving and investing in order to shore up that shortfall. Just saying. And I think the fourth scenario is essentially pushing back the retirement age. So messing with the full retirement age and even the latest retirement age. I mentioned when Social Security first came about, 65 was the full retirement age. Today it's 67. So does that make sense based on how much longer people are living? So the challenge though is people are retiring earlier. I've noticed a trend. Many people are looking at either work optional or doing some sort of phased retirement, and they're looking at that at 60, 62, 63, 64, well before their full retirement age or well before that latest age you can file Social Security, which is age 70. So, what's going to be the gap there to shore up that shortfall? Either part-time income, investment income, of course. So I think there's going to be significant impact there. But what do they push that to? Do they push full retirement age to 72, 73, 74, 75 even, and then push back that latest delayed credit age to maybe 80, 85? I have no idea. Okay, but I think they can definitely look at this in conjunction with some of these other things to come up with a solution. Because at the end of the day, if nothing changes, we're just going to be running into the scenario where 80% of the benefits are being paid out and people are getting ticked off because they keep paying into the system that is set up to fail. Okay. And so, yeah, I think, whoever, the politicians in Washington right now, I don't envy them. They have a very tough job here with regards to Social Security. Again, if it were up to me, I'd say, don't tax my benefit. Don't even pay into Social Security. Let me take that 6.2%. Let me invest that on my own. Give me the 6.2% from my employer. Let me invest that on my own, and I'll create my own Social Security plan. Okay, but that's, again, not how our country works, not how Social Security works. But let's talk about some strategies that you can implement to potentially improve the tax efficiency. Okay, so improve the tax efficiency of your income, which ultimately will improve the tax efficiency of Social Security, meaning reduce that provisional income and therefore reduce that amount that's going to be included as taxable income from your Social Security benefit. So the first one I'll throw in there is one of my favorites, and this is Roth conversions. Okay, so in that provisional income calculation, Roth IRA distributions, assuming they were qualified, assuming they were tax-free, is not included in that provisional income calculation, okay? Now, certainly conversions will be. So if you're aggressively doing some conversions and you've started Social Security, it's going to create a lot of taxes on that Social Security benefit temporarily, but ultimately if the long-term benefit is reducing those RMDs, reducing those required minimum distributions, and ultimately then making your retirement income more tax-free later on, could be a really good strategy to look at with regards to maximizing the tax efficiency of not only your retirement income, but of course, Social Security taxes. The second thing I'll throw in here is tax loss harvesting. So essentially here, we looked at that example before where part of the income coming in for that provisional income calculation was $15,000. Well, what if you build up a little bit of a war chest of these losses over time? So you build up this little war chest of losses. Okay. And what I mean by that is, over time, investments are going to have volatility in there. I mean, we've had some volatility so far in the fourth quarter in 2024, even in Q1 in 2025. And if you have investments inside of these types of accounts that generate capital gains, there could be an opportunity at some point in time to actually sell something at a loss. So turning a paper loss into a realized loss, those losses can be used to offset capital gains. And if you have no capital gains that particular year, you can use up to $3,000 to reduce your adjusted gross income. So again, pushing this down and then also potentially just pushing down your AGI in general, your adjusted gross income in general. Okay. So over time, you can build up this little war chest of carry forward losses that you can then turn around and use to offset some of those capital gains in retirement. So in those early years of retirement, and let's say you're tapping into that taxable brokerage account fairly aggressively, if you have some of these losses, you can basically have very little to even no taxable income on the capital gain side if you've got enough in the war chest. All right, number 3, I'm going to throw in here is QCDs, or qualified charitable distributions. Now, these are for individuals that are over the age of 70 and a half. They can contribute upwards of $107,000 directly to charity from their own IRA. Okay, so if they do that, they can reduce their required minimum distributions if they are subject to them. So let me explain how this potentially could work. Let's say right here, you've got this $20,000 distribution. Let's say this is an RMD. Let's say that's the required minimum distribution. Maybe you're 73, 75 years old, whatever that might be. But let's say you know what, Kevin, I don't need all of that. I only need maybe 5,000 of that income, but I have to take out 20, otherwise I get slapped with a 25% penalty. But normally I donate $5 or $10 or $15,000 directly to charity, but I've been doing it from cash. I just donate and write a check. Well, instead of doing that, what you can do is you can make that donation directly from your IRA to that charity and reduce that RMD dollar for dollar, again, up to that 107. I think it's either 107 or $108,000 for 2025. So ultimately, the benefit here is if you're charitably inclined, instead of realizing all of those IRA distributions as income, again, this is for folks that are over the age of 70 and a half, you can take advantage of charitable giving in the most tax efficient way possible. And in this case, doing it directly from your IRA. And then better yet, if you're already taking required minimum distributions, it would then reduce those RMDs dollar for dollar. And then the last thing I'll throw in here is number 4, is just tax efficient withdrawals. Now, you might have annuities, non-qualified annuities. You might have taxable brokerage accounts. You might have tax-deferred accounts inside of IRAs. You might have tax-free accounts like HSAs or Roth accounts. So I think the gist here is looking at all of your potential asset and income sources, okay, and looking at the timing of those income sources and then figuring out, hey, based on when I'm taking Social Security, how can I sort of maximize the tax efficiency of my income, not only today, but when I begin taking that Social Security? So again, looking at potentially even distributions from those Roth accounts, looking at distributions from those IRA accounts earlier than you necessarily needed to take those RMDs, and ultimately looking at those taxable brokerage accounts, looking at HSAs, looking at non-qualified annuities to, again, maximize the tax efficiency of your income, which ultimately could push down your adjusted gross income and, again, put more money in your pocket and reduce the amount of your Social Security that is subject to income taxes. Hope you all found this helpful. That's it for today. For those of you that are interested, the podcast that's coming out next Tuesday, Planning for Retirement podcast, is going to be one of our whiteboard retirement plan versions where I essentially break down a retiree's plans for retirement and ultimately identify opportunities and use it for educational purposes. So for this upcoming whiteboard retirement plan, I'm going to be using a particular client of ours that is going to be implementing one or even more of these strategies to make their Social Security more tax efficient. And so just make sure to subscribe to the channel, make sure to follow our channel so you don't miss out on that one. And of course, if you've gotten this far, if you liked our video, make sure to like the video and make sure to comment below. It helps us reach out to as many people as possible there, which is what we're looking to do. Until next time, everybody, thank you for tuning in. I'll see you then.